Welcome back to another episode. There's a few things I want to go over in this video today, but first I want to clarify some of the account values. Going forward, I'm going to be going off of the Wealthsimple trade value of about 16,500. In previous episodes, I have included an RSP held in a different account with Royal Bank, and since you, the audience, cannot see that account, I will not be including it into the portfolio anymore. I want to be as transparent as I can be in these videos, and to show you that, I want to only include the Wealthsimple trade portfolio, which includes the personal account, an RSP, and a TFSA. So there has been some activity in this portfolio over the last few weeks. If we check out the amount of dividends that we have received, in January, there have been 7 dividends, with the most recent being Algonquin at almost $28 total. Go Easy also paid out $9.10. DFN was an old holding that I held in December, and we received $4.20. VDY, I received $11. This is a monthly pair. This is the largest ETF in the account right now at $3,500. They will pay out between $10 and $15 per month, depending on which month it is. TELUS also paid out $9.60. And VTI paid out in the RSP and the personal account on January 3rd. So as you can see, we receive a decent amount of funds in January so far, and we take these funds and reinvest them back into the portfolio in buying new shares of the stocks we like or ETFs, and we compound our returns that way by receiving more dividends the next time they pay them because we hold more shares. So this is the general idea of the account and our strategy going forward. In today's video, I want to go over Algonquin Power and what news they have released in the previous week and how that'll influence my portfolio and the company going forward. For anyone who doesn't know, Algonquin Power Utilities is the parent company of Liberty and is a diversified international generation, transmission, and distribution utility with over $17 billion in total assets. I believe this has increased to over $20 billion in the last 3 years. Algonquin Power is committed to pursuing growth and operational excellence in a sustainable manner through an expanding global pipeline of renewable energy and electric transmission development projects, organic growth within its rate-regulated generation, distribution, and transmission businesses, and the pursuit of accretive acquisitions and value-enhancing recycling of assets. So Algonquin Power is within the utility sector, and the news they released this week on January 12th was related to its dividend and future outlook in 2023. So they state that they have built a solid foundation supporting their asset portfolio of energy generation and transmission. They believe they have reached an inflection point as the markets evolve, and they need to adjust their business model accordingly. So they're taking steps to realign their capital allocation to reduce capital expenditures, refocus the portfolio, and reduce the dividend in order to position the company for sustainable long-term growth. So in the past, they have borrowed a lot of money, but used the money very well to generate revenue. With this revenue, they issued dividends, and over the last many years, they have increased these dividends very regularly. And it seems like it's to the extent where they've been pushing the dividend too far, and it's been taking a toll on the debt that they have acquired. In many instances, and we'll go over this later in the video, but there are many instances where they've borrowed more than 100% of their earnings to pay dividends. And despite having this over 100% payout ratio, they have done very well in the last 10 or so years for growing the company. And they believe that they need to restructure this attitude to make this more sustainable for investors in the future. The CEO says, "We remain committed to our long-term energy transition, including the pursuit of the Kentucky Power acquisition." So they want to restructure their business and outlook while also focusing on growth for future revenue. And so they are looking at growth still, despite trying to retract their dividend. Their dividend will be reduced by about 40%. These values are in US dollars, so I will adjust these later on to see how this looks in Canadian. So it will go down from 18 cents to about 11 cents per common share. AQN will continue distributions to shareholders with a sustainable dividend that is expected to grow in general alignment with adjusted net earnings per share. So it looks like they're taking back some of the dividend increases that they have done in the past few years, and they want to grow it more sustainably with the earnings in more recent futures. Algonquin intends to refocus its portfolio by targeting approximately $1 billion of additional asset sales. Proceeds from the next phase of renewable asset recycling and additional asset asset sales are expected to be used to pay down debt and continue to fund growth. So like I said, they were borrowing a lot of money and they want to pay off some of this debt before continuing the growth. And by doing this, they need to reduce the dividend that they're paying to investors. So this is all seems very natural for what the company has been doing. The last few years, interest rates have been very low and cheap to borrow money. So naturally, they made their stock look very appealing to dividend investors and funds. But by doing this, they put themselves at risk for interest rate hikes and taking on lots of debt. So shareholders participating in the DRIP will begin receiving cash dividends if the company elects to reinstate the DRIP in the future. So they will be taking away the DRIP, and this isn't all that different from, from normal operations. People who are in this DRIP program will only be receiving cash now and instead of shares. This does not affect me in any way, but this might slow down some of the recycling and churn of company shares in general. Algonquin Power expects adjusted net earnings per common share, excluding gains or losses of asset sales. They have changed their outlook of their earnings from, I believe it was maybe 80 cents per share to approximately 55 cents per share, and this is all in USD for the 2023 fiscal year. So from these estimations, we can give a value of what we think Algonquin Power should be traded at. We can see how it fits into our portfolio in general. So let's go over some of the charts of Algonquin Power and see how that will affect their future outlook. So in the last 5 years, you can see that this steady growth, while also paying a dividend, is very steady until this last year or so when they actually dropped about 40 or 50% in a matter of months. This chart shows exactly what they've been doing. They've been borrowing lots of debt while also increasing revenue and without having to service their debt very much until recently, until they believe that they will be dinged pretty hard for their debt and their interest rates. This is the past while. This is the past year. It's down 45% in the past year. They're trading at about $18 or $19, and currently they're trading at $9.50. And I believe the last trading day they were below $9. So this is very drastic change in the price, and we have to decide if this is a place that is valuing Algonquin fairly, or we need to adjust our position in Algonquin. Right here, this is their quarterly dividends. They've been increasing their quarterly dividends by quite a bit, and this is the adjusted to Canadian dollars. They will about 25 cents to about 14 cents will be the adjusted dividend payout per quarter. This will bring them back to about maybe 2017, 2018 in the dividend space. So they're going to lose about 6 years of dividend growth, but they are intending to grow on this similar trajectory as long as they can maintain the revenue and earnings as they did in the past. So this is their quarterly revenue, and if they can bring this chart into the future and kind of remain on this similar path, they should be able to increase their dividend in a very similar way. So this is a quarterly EPS, earnings per share, and this is what they've changed their outlook on. So 74 cents, between 74 cents and 82 cents, and it's down from the previous estimate of 89 cents to 93 cents. So they're anticipating a drop in earnings in the next year. And if we look back, this is for the year, so it ends up being about 20 cents per share per quarter, and that ends up being somewhere in the 2019 average year. So again, they're losing 4 or 5 years of growth that they did do earlier in the company's history. So through their estimations of their annual EPS, we can predict what their payout ratio is going to be based on their dividend cut as well. So 4 quarters, they're going to be paying out about 14 cents. Over that year, they're going to earn 74 cents, and this is the low end of their estimation. I think this goes up to about 80 cents or so. So we take the low end, and if we expand this out, it ends up being about a 76% payout ratio. So that means that they're going to be paying 76% of their earnings out to investors as a dividend. Now, if we see in the past, their payout ratio has fluctuated between 75-60% to well over 100% to 300%, right? And this was something that the management wanted to address, was that they want to refrain from going over 100% and make this dividend very sustainable in the future. And by doing this, they needed to reduce the dividend for their future outlook in 2023. This seems like a very logistical point of view, and I actually do like it for the company's health. It's very sustainable to have a payout ratio under 80%, let's say, because they can reinvest the remaining into the company and buy new acquisitions and new properties and that sort of thing. So I do think that this is very solid for what they're looking to do in the future. This is the price earnings ratio. So in the past, we've seen 95 very high PE ratios, 70, 77, and this indicates that investors are willing to pay a very high premium to own this company compared to their earnings. They believe that this company is going to grow earnings very rapidly, and it's going to be very beneficial to the investor to hold this company. These are very drastic PEs, and if we tone this down to maybe what the market would pay for this company, maybe like a 20-25 PE, we can actually make a price estimate on what the stock should be trading at. To make a price estimate, if the EPS is about 74 cents Canadian and a PE estimate, which is what the investor is willing to pay for the company, of 20 times the earnings, we can come out to be about $14.80. And this is quite a bit lower than what it's trading at right now. This is the most recent snapshot of what Algonquin Power is trading at. It's hard to know if this $14 is a good price estimate for this company. It seems like the company is really looking out for the future and wants to be able to sustain growth in a better manner, but it's also, investors are believing that it's not going to do that, as it is trading at under $9 compared to maybe around 15, which it maybe is what it should be trading at. Let's go take a look at our position and see how it looks on our end and how many shares we own and what it looks like. So in the portfolio, we see that Algonquin Power is trading at $8.9 Canadian, and in our TFSA we have 119 shares for a total value of just over $1,000. All-time performance, we are down 50%. Now this is not including dividends. I've held this company for over 2 years and averaged into a cost of $18 a share, and this is actually very high compared to the price. It's down 50%, but I have received 8 dividends, probably about $200 in dividends. So this is not reflectant of total returns, but just price appreciation. So this is accounting for 8% of my total TFSA portfolio. Now, I do think Algonquin Power is taking appropriate measures to preserve their status as a utility player in North America. I don't know if this is the correct place to enter a position. I am already very overweight as it is in this company. So overextending any further might be very dangerous for the total returns in this portfolio. So going forward, I'm not going to be buying any more shares, but I'm also not going to be selling my shares, as I think they will do decently well in the next few years to come, like they addressed in their statement. So I will not be selling any of my shares. I will just be collecting my dividends and reinvesting them in other places in the portfolio as of right now. Let's go check on some of the other holdings I have as of late and see how they've been doing compared to Algonquin. So as you can see, the portfolio is at 16,501. We're going to leave the personal account out of this just because there aren't many holdings in there. It's mostly Berkshire B and VTI. But let's get into the RSP. We are at just under $1,800 US. And over the 3-month period, we're actually up 8%, which is about 127 US. When we go through some of the holdings here, we have QQQ, SCHD, VOO, and VTI. And in fact, almost all of them are in the green except VOO, which is actually only down 0.19%. So all-time returns, our best performer in this space is our SCHD, as it is up 5.5%. We do have $200 US to invest. I will be pocketing this money until I do see appropriate times in the market. So we'll just be leaving our funds in this account for now. I will be keeping you up to date on any buys and sells I do in any of these accounts because I want to be as transparent as possible. So the TFSA has $13,000, just over $13,000 in it. And it has a variety of companies in it, which differs from the RSP, as the RSP only has 4 or 5 ETFs in it. In this portfolio, I hold Algonquin Power, ATD. This is Circle K and convenience stores. Bell Media, Bank of Nova Scotia, Canadian Imperial Bank, Emera, Enbridge, Fortis, GoEasy, Power Corporation, Pembina, TELUS, the Toronto Dominion Bank, TC Energy Corp, and VDY. VDY is the biggest holding by far in this portfolio at 81 shares, which is about $3,500 Canadian. Now, I do want to trim down some of these positions going forward. I will be taking a closer look at Bell, Canadian Imperial Bank, and TC Energy Corp, as I want to concentrate my portfolio into the best of the best in the Canadian sector, which in my opinion would be Toronto Dominion Bank, Pembina for energy, and also Power Corp for insurance and also financials as well. So thanks for tuning into this episode. Remember to leave a like and subscribe if you want to see more updates on this portfolio. Also, if you have any other ideas of what you want to see, whether it's ETF reviews or stock reviews, just leave a comment below